Welcome to the Deep Dive. Today we're digging into the world of Peter Lynch, really one of the greats in fund management.
Absolutely, a legendary figure.
And we're focusing on his classic book, One Up on Wall Street. The idea here, our sort of mission, is exploring how Lynch thought regular investors, people like you listening, might actually have an edge over the professionals.
It's a fascinating premise.
It really is.
Yeah.
Lynch's whole philosophy is, well, it's incredibly empowering. He basically argued that you, through your everyday life, already have insights that could lead to some fantastic investment finds. So we're going to unpack the actual strategies from the book, see how you might just maybe use what you already know to beat the street, as they say.
And what's so interesting about Lynch, I think, is that he kind of throws out the idea that you need super complex math or some kind of secret insider info.
Right.
This deep dive is really about blending that everyday common sense, your unique observations with, and this is key, solid fundamental analysis.
Can't skip that part.
No way. The goal is to help you approach the market with, let's say, diligence, patience, and a really grounded, down-to-earth perspective.
Okay, so let's dive right in. Lynch's were a foundational idea. Invest in what you know. Now this sounds simple, maybe too simple.
It does on the surface.
He wasn't just saying, oh, buy Apple because you have an iPhone. It was deeper. He really believed the best starting points often come from, well, daily life.
Like where?
Like noticing things at the mall, or maybe a tool you start using constantly at work, or just seeing some new service that suddenly everyone seems to be using. Maybe a product is always sold out, or there's always a line. For Lynch, that was like your personal early signal.
And the power there, the reason that's so potent is you get this immediate, almost gut-level feel for a company's product or service.
Right. You see it working or not working.
Exactly. You're seeing market trends happen right in front of you, sometimes way before the Wall Street analysts pick up on it. It's a grassroots view.
Okay, so you get that grassroots view. But, and I think this is where people might get tripped up, isn't it tempting to just, see that popular product and jump right in, buy the stock based on that feeling alone? How did Lynch warn against that?
Oh, he was incredibly clear about this, that observation. That's just the spark. It's the starting point, not the finish line.
Okay.
Even if the idea comes from your own experience, you absolutely have to do your homework. Thorough research is, well, it's everything.
And what does homework actually mean in Lynch's world?
It means really getting into the company's fundamentals, understanding its earnings. Are they growing? How fast? What about debt? Too much debt is a killer.
Always a red flag.
It's a huge red flag. And what's the real growth potential? You need to check if that initial observation, that story, is backed up by solid numbers.
Got it. So the observation gets you interested, but the homework validates whether it's a real opportunity. It turns that hunch into like an actual investment thesis.
Precisely. And once you've started that homework, Lynch provides another really useful tool. His framework for thinking about different kinds of companies.
Ah, the 6 categories of stocks. I remember reading about these.
Yes, and they're super important for setting the right expectations, for figuring out your strategy for a particular stock.
So it's not just slapping a label on it.
No, not at all. It's about understanding the company's basic character. So first up, you have slow growers.
Okay, like big old established companies.
Pretty much. Think utilities, maybe some mature industrial giants. They grow, but maybe just a little faster than the economy. Lynch often saw these as, well, maybe sources of dividends, but not huge capital gains. Sometimes he called them no-growers in disguise.
Right. Safe, but maybe a bit boring if you're looking for growth.
Exactly. Then you have the Stalwarts. These are also large established companies, but they have more consistent, moderate earnings growth. Think, Coca-Cola or Procter & Gamble back in the day. Reliable.
The foundation of a portfolio, maybe?
Could be. Dependable performers. But then Lynch's favorite category.
Let me guess. Fast growers.
You got it. These are often smaller, more aggressive companies expanding really quickly, maybe 20-25% growth per year. This is where Lynch found a lot of his biggest winners, his multi-baggers.
Makes sense. High growth, high potential return. Also higher risk, I assume.
Definitely higher risk. Then there are cyclicals. Their fortunes really rise and fall with the overall economy.
Like car companies?
Yeah.
Airlines?
Perfect examples. When the economy's booming, they do great. When it tanks, they can get hit hard. Timing is more critical here.
Okay, 2 more categories left.
Right. Turnarounds. These are companies that have been through some rough times, maybe poor management or a market shift, but they're showing signs of recovering.
So digging for hidden value there.
Exactly. If you can spot a genuine turnaround early, the rewards can be substantial. But again, they're risky. Many turnarounds don't actually turn around.
Fair point. And the last one.
Asset plays. These are companies sitting on some kind of valuable asset that the market hasn't fully recognized or valued correctly.
Like what kind of asset?
Could be real estate, maybe a block of patents, a pile of cash, even sometimes tax losses. Something hidden on the balance sheet that makes the company worth more than its current operations suggest.
Okay, so understanding these 6 categories, how does it really change how you invest beyond just, sorting companies?
It fundamentally changes your expectations and your strategy. You wouldn't buy a slow grower expecting fast grower returns, right?
No, that seems obvious when you put it that way.
And you wouldn't expect a cyclical to be stable like a stalwart during a recession. It helps you avoid comparing apples and oranges. It tells you what kind of performance is realistic for that type of company. It's about matching the stock's nature to your goals.
That makes a lot of sense.
Oh.
So you find an idea through observation, you do your homework, you figure out which category it fits into. But Lynch was also huge on the actual numbers, wasn't he?
Absolutely critical. That common sense part gets you started, but the quantitative stuff, the numbers, have to back it up.
So which numbers did he really zero in on? I mean, there are tons of metrics out there.
He definitely had his favorites. Of course, the basic PE ratio, the price to earnings, was important. But he was arguably much more focused on the PEG ratio.
The PEG, that's price to earnings to growth, right?
Exactly. He loved the PEG ratio because it adds context to the PE. A high PE might be okay if the earnings are growing really fast. A low PEG, ideally below 1, suggested you weren't overpaying for that growth.
Okay. So it balances price against future potential.
Precisely. He also looked hard at sustained earnings growth. Is it consistent? Is it accelerating? And debt levels. Lynch really disliked companies loaded with debt. Too much leverage adds huge risk.
Understandable. What else?
He even looked at things like inventory levels. If inventories are piling up faster than sales, it might be a sign that demand is softening, even if the earnings look okay for now. It's about getting a feel for the underlying health of the business.
So it's a whole picture, not just 1 or 2 numbers.
Definitely. It's about using the numbers to confirm or deny the story you initially developed from your observation and understanding of the business category.
Okay, thinking bigger picture now. All this homework, understanding the categories, digging into numbers, it implies a certain amount of commitment, doesn't it? Which ties into Lynch's view on holding investments.
Absolutely. He was a huge proponent of, essentially buy and hold investing, though maybe buy and do your homework continuously is more accurate.
Yeah.
His core belief was that time in the market is way more important than trying to time the market, trying to jump in and out based on predictions. He thought that was mostly a losing game.
Didn't he have a famous quote about that? About market corrections?
He did. Something like, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves.
Wow, that's powerful.
It really is. He believed you make the real money by sticking with good companies, sometimes for many years, letting them compound. Patience is crucial.
And that patience directly counters the urge to panic sell during downturns, right? Trusting your initial research.
Exactly. If the company's fundamentals are still strong, a market drop might even be a buying opportunity, not a reason to sell in fear. But this brings up another point. What about all the distractions?
You mean the constant news cycle, the market forecasts, the talking heads on TV?
All of that. The noise, as Lynch might call it. He was very clear. You need to learn to ignore most of it.
Ignore it. Like completely.
Pretty much. Ignore the market hype, ignore the complex economic forecasts. He famously said he didn't pay much attention to them, and definitely ignore the media panic when things get volatile.
Why? What's the danger?
The danger is it makes you emotional. It makes you second-guess your own research based on factors that might have nothing to do with your specific companies. Lynch's advice was always, focus relentlessly on the individual companies you own.
Their actual performance.
Their performance, their fundamentals, how their story is playing out. That's what matters, not the day-to-day market mood swings or what some pundit predicts interest rates will do next year.
Okay, that's a really disciplined approach. Now let's shift to something really exciting that Lynch is famous for. The concept of 10-baggers.
Ah, yes. The holy grail for many investors.
Sounds amazing. What exactly is a 10-bagger, and why was it such a focus for him?
It's pretty straightforward, actually. A 10-bagger is simply a stock that goes up 10 times from your purchase price. So So if you invest $1,000, it turns into $10,000.
Okay, wow.
And Lynch focused on them because finding just 1 or 2 10-baggers over your investing lifetime can have a massive impact on your overall portfolio performance. They can make up for a lot of mistakes or smaller gains.
So where did he typically find these elusive 10-baggers? Did they come from the Stalwarts?
Usually not. He found they typically came from the small or mid-cap space, specifically from his favorite category.
The fast growers.
Exactly. Those rapidly expanding companies with innovative products or services, tapping into big markets. Finding them early and having the patience to hold them as they grew, sometimes for years, that was the key. It ties back to the homework and the long-term view.
It all connects. So we've covered observation, homework, categories, numbers, patience, ignoring noise, finding 10-baggers. As we wrap up, what's the sort of final overarching wisdom from Lynch for the individual investor?
I think it really comes down to staying humble and staying curious. Lynch was always clear that nobody can predict the future. Nobody knows for sure what the market will do.
Right, no crystal balls.
No crystal balls. So what can you control? You can control your process. Stay disciplined, keep learning about companies, about industries, about your own mistakes, and crucially, stay within your circle of competence.
Meaning stick to investing in things you can genuinely understand.
Precisely. Don't chase hot stocks in industries you know nothing out just because everyone else is. Focus on areas where your invest in what you know edge, combined with your homework, gives you a real advantage.
So pulling it all together, One Up on Wall Street isn't just some dusty investment book. It feels more like a really practical, almost optimistic guide. It empowers you, the individual investor.
It really does. It shows how combining that common sense, those unique insights you already have, with rigorous fundamental analysis can genuinely help you navigate the market, maybe even find that edge Lynch talked about.
And it highlights those timeless investing virtues, doesn't it?
Absolutely. Diligence doing the work, patience sticking with your good ideas, and just a straightforward, down-to-earth approach. It removes the mystique and shows how anyone, really, if they put in the effort, can apply these ideas.
So a final thought for everyone listening, something to maybe mull over after this deep dive. How could you start applying that invest in what you know idea starting today? What products, services, or companies do you encounter regularly that genuinely impress you or seem to be gaining real momentum?
Good question to ponder.
And then the crucial follow-up. What specific homework, what numbers, what research would you need to do next to turn that everyday observation into a potential well-researched investment insight for your own portfolio?